So we really need to talk about what happens when a supposedly bulletproof stock just takes a sudden violent hit.
Yeah, it is the ultimate stress test for any business model, really.
Exactly. Because a few months ago, this company looked practically invincible, you know. But today, the market is pricing in a completely different reality.
Right. When the operating environment turns hostile, you finally get to see the real difference between a company that just relies on smooth sailing and one that actually has a resilient underlying structure.
I couldn't agree more. So welcome back to the Deep Dive, everyone. Think of today's discussion as the highly anticipated follow-up to our ongoing coverage of Heineken Malaysia.
Stock code HEIM for those tracking it.
Right, AI. And if you recall our previous analysis,
hmm
talking about the YouTube video we did, IMZL5 UBVC, Heineken Malaysia FY 2025, the 100% dividend payout machine, we were looking at an absolute financial fortress.
Oh, absolutely. Zero debt.
Right. Zero debt, a flawless dividend payout ratio, and, we awarded them a solid 8 out of 10 on our financial moat scorecard.
Because the operational momentum during that Q4 2025 period was just incredibly strong. I mean, it was heavily supported by festive spending and really effective cost management.
But today is August 6, 2026, and the scenery has completely shifted.
It's a completely different picture now.
It really is. Following a heavily negative Q2 2026 earnings report, Heineken Malaysia's stock price plummeted from 19 ringgit straight down to 17 ringgit.
Which is, yeah, that's a massive hit.
A whopping 10.5% drop. I mean, that wipes out months of gains and drags the stock down to levels we basically haven't seen since December 2023.
It really is a brutal correction.
So our mission today for you listening is to cut through all this market panic. Why did the stock drop so sharply?
Right.
Is the company's future growth truly at stake here, or did the market just completely overreact?
That's the big question.
Yeah, and ultimately, is this 17 ringgit price point a golden opportunity to step in, a signal to hold, or a blaring warning siren to trim your position?
Well, to get to the bottom of that, we are going to systematically deconstruct this Q2 2026 financial report.
Break it all down.
Exactly. We will overlay the raw numbers with the latest analyst commentary from Hong Leong Investment Bank, or HLIB, and TA Securities.
Okay.
Plus, we really need to dissect the underlying mechanics that are currently spooking retail investors, specifically that steadily declining net tangible assets metric.
Oh, man. People are panicking about the NTA.
They are, and we'll get into why. And finally, we have to recalibrate that financial moat scorecard to reflect the current operating reality.
Sounds like a plan.
Huh.
So let's start with the headline numbers from Q2 2026, because they are undeniably ugly.
Very ugly.
Revenue fell 19.5% year-on-year, down to 434.7 million ringgit.
And the net profit took an even deeper dive.
A massive dive.
Yeah, plunging 39% down to 50.5 million ringgit.
And if you compare it sequentially to just the previous quarter, Q1 2026, it looks even worse.
Oh, don't even get me started on the quarter-on-quarter numbers. Revenue is down 35% and profit is down 52%. I mean, those are heavy contractions for a consumer staple.
Right. People usually keep buying beer, so they're severe. To understand the mechanics of that drop, what are we looking at?
Well, we have to isolate the two distinct engines driving it. The first is entirely macroeconomic.
Okay, macro stuff.
Right. We are seeing a marked softening in consumer sentiment, driven primarily by inflation and geopolitical uncertainties.
Yeah, the cost of living is biting.
Exactly. And the management report specifically points to the ongoing crisis in the Middle East.
Okay, let's pause and connect those dots for a second, because how does a shipping and geopolitical crisis in the Middle East translate to fewer Heineken sales in Malaysia?
I know it sounds disconnected, but it comes down to supply chain friction and imported inflation.
Right.
When major shipping lanes are disrupted, global freight rates just spike.
Which makes everything more expensive to bring in.
Exactly. It increases the cost of imported goods across the board in Malaysia, so when everyday essentials become more expensive, the local consumer's discretionary income just shrinks.
They have less money in their pocket at the end of the week.
Spot on. So what happens to their alcohol consumption? They trade down.
They stopped going to the fancy bars.
Right. Instead of buying a premium pint at a high-margin bar or restaurant, what the industry calls the on-trade channel, they buy a cheaper local alternative.
Or they just pick up a six-pack from the supermarket to drink at home.
Exactly. And that shift directly cannibalizes HEIM's highest margin sales.
Got it. And real quick, before we hit the second engine, We also have to acknowledge there's always background noise in Malaysia regarding political risk,
Oh, certainly.
like chatter about PAS and upcoming GE elections making the market a bit jittery. We're not taking any political sides here at all, just noting that uh, political noise can generally dampen consumer and investor sentiment.
It absolutely adds a layer of caution to the macro environment. Investors don't like uncertainty.
Right, okay. So the macro environment is squeezing the consumer's wallet, which in turn squeezes HEIM's margins. That makes total sense.
Yeah.
But you mentioned a second engine driving this profit plunge.
Yeah, the second factor is a deliberate internal choice by HEIM's management.
Deliberate.
Yeah, they initiated a strategy called inventory normalization.
Okay, let's unpack this. What does that actually mean?
In plain terms, management intentionally reduced their ex-brewery sales.
Wait, they chose to sell less beer?
They actively chose to sell less beer to their own distributors
Why would they do that?
to ensure that the inventory sitting in the wholesale warehouses aligns with that slower consumer demand we just talked about.
Okay, I have to push back on that phrasing.
Go for it.
Because if a company is deliberately choosing to sell less of their core product to their distributors, isn't that just a convenient corporate speak excuse for losing market share?
It does sound like a spin, I'll admit.
It sounds a bit like a restaurant claiming they intentionally sold less steak on a Friday night just to keep their walk-in freezer nicely organized.
That is a totally valid skepticism. I mean, management teams love to dress up bad news in strategic language.
Exactly.
But in the fast-moving consumer goods sector, pushing excess product onto your distributors when consumer demand is weak is incredibly destructive.
Why is it so bad?
It's a practice called channel stuffing.
Ah, okay. So you force the distributor to buy the beer so your quarterly revenue looks good on paper.
Exactly. And that creates a massive downstream bubble. You have to remember, beer has a shelf life.
Right. It goes bad.
If HEIM forces distributors to hold inventory they cannot move, those distributors eventually panic.
Because they're sitting on expiring stock.
Right, so they have to heavily discount the beer to clear it out before it expires.
Oh, I see where this is going.
Yeah, when consumers see a premium brand like Heineken being aggressively slashed in price across retail channels, it permanently degrades the brand's premium positioning.
You lose the prestige.
Exactly. So by choking off the supply now, HEIM is taking a massive, painful hit to their Q2 bottom line. But they are protecting the long-term pricing power of the brand.
Okay, wow. That actually explains the revenue drop. But it doesn't quite explain the profit discrepancy.
What do you mean?
Well, revenue fell 19.5%, right? But profit fell almost double that 39%.
Yes.
Why does a strategic volume cut punish the bottom line so disproportionately?
This is where we see the sheer mechanical force of operating leverage at play.
Operating leverage. Okay, break that down for us.
Breweries are heavily capital intensive. You're talking about massive stainless steel fermentation tanks, complex bottling lines, unionized labor,
Right.
and continuous energy consumption required to maintain strict temperature controls 24 hours a day.
So massive fixed costs.
Massive fixed costs. They do not disappear just because management decides to brew 20% less beer this month.
The overhead stays the exact same, but you have fewer bottles to absorb the cost,
Exactly. So the production cost per individual bottle spikes dramatically.
which crushes the profit margin.
It forces profit margins to compress violently. And we see the exact math in the Q2 report.
Let's hear it.
The profit before tax margin shrank down to 15.3%.
Ouch.
Yeah. Compare that to the surging 22.7% margin we analyzed back in Q3 2025.
That is a huge drop.
That difference is pure fixed cost deleveraging. The efficiency initiatives the company implemented, they just simply could not outpace the sheer mathematical weight of lost volume.
Man. So if the operating margins are that vulnerable to volume shocks, we have to talk about our financial moat scorecard.
We do.
Because in our previous deep dives, we awarded Heineken Malaysia a very strong 8 out of 10.
We did.
Considering the bloodbath in these Q2 numbers, where are we setting that score today?
I am officially adjusting the financial moat scorecard down to a 7.5 out of 10.
A half-point deduction.
Right. That 0.5 deduction is strictly isolating the near-term margin stress and the fixed cost deleveraging we just outlined.
Makes sense.
Under our pricing power and margin vulnerability metric, they proved they could seamlessly pass on a 10% alcohol tax hike to consumers previously.
Right. They handle that well.
But this quarter proves that a severe, sudden volume contraction still deeply exposes the rigid nature of their cost structure.
You can't outrun the fixed costs.
Exactly. That said, a 7.5 is still a highly robust score.
Yeah, it's not a failing grade by any means.
No. The core pillars of their moat, the entrenched brand equity, the established duopoly market structure in Malaysia, and their phenomenal cash generation, those remain structurally intact.
Well, let's test that structural integrity then, because there is a glaring red flag in this Q2 report that is basically dominating retail investor forums right now.
The NTA.
Yes, the balance sheet. Specifically the net tangible assets, or NTA. The net assets per share has been steadily marching downward. I mean, it sat at 1 ringgit 76 cent at the end of December 2025.
Correct.
By June 2026, it was down to 1 ringgit 32 cent. And today, it sits at just 1 ringgit 15 cent.
It looks bad on paper, I know.
To a casual observer, looking strictly at the asset sheet, it appears the company is actively shrinking and destroying its own underlying value.
This is a classic example of why looking at isolated balance sheet metrics without historical context is dangerous.
So solve the mystery for us. What's fascinating here is what?
What's fascinating here is that the panic over the declining NTA directly ties back to the core thesis of our previous deep dive.
The 100% dividend payout machine.
Exactly. The NTA is not dropping because the company is writing off toxic assets.
Right.
Or because the breweries are depreciating faster than expected. Or because they're loading up on debt.
So where did the money go?
The NTA dropped strictly because they paid out that massive 338.35 million Winggit final FY25 dividend.
The accounting mechanics of a massive payout.
Exactly. When a company declares and pays a dividend, that cash physically leaves the company's balance sheet.
It goes into our pockets.
Right. It reduces retained earnings, which directly reduces total shareholders' funds.
Okay, follow.
And when shareholders' funds drop, your net tangible assets per share drops proportionally.
So the NTA is shrinking because the company is actively rewarding investors.
Yes. It is the mechanical reality of a company running a 100% payout ratio.
Right.
They generate massive cash, and rather than hoarding it to artificially inflate their balance sheet, they flush it out to the shareholders.
The math completely adds up. I mean, the missing asset value didn't just vanish into thin air.
And no, it didn't.
It was quite literally transferred into the investor's personal bank account as a dividend yield.
Exactly.
So the panic over the NTA metric is completely misplaced.
It is a fundamental misunderstanding of cash-generative businesses.
You know, if you are listening right now and finding value in this kind of financial demystification where we strip away the market panic and look at the actual accounting mechanics driving these scary numbers, please hit that like button and subscribe to the YouTube channel.
It really helps us out.
It is the absolute best way to make sure you never miss a deep dive into the real stories hiding inside these corporate reports.
Because looking past the surface metrics is the only way to find actual value in a volatile market.
Well said. So let's apply that logic to the 17 ringgit share price.
Okay, let's...
Because this is the core dilemma for anyone watching this stock. The price has fallen off a cliff.
It has.
What is the institutional perspective? What are the analysts actually saying in the wake of a 39% profit plunge?
The institutional reaction is surprisingly measured.
Really?
Yeah. Look at the latest report from Hong Leong Investment Bank. They are not ignoring the macroeconomic pain.
Okay.
HLA aggressively slashed their earnings forecasts for HEIM by 16.5% for FY26.
16.5%. Slashing near-term earnings forecasts by that much is a massive capitulation.
It is a major adjustment. And they trimmed FY27 and FY28 by about 8% to factor in these lower sales assumptions too.
So they are fully acknowledging the pain.
Yes. However, despite gutting the near-term earnings outlook, HLIB maintained a firm buy recommendation on the stock.
Wait, a buy?
A buy. And they set a target price of 25 ringgit 65 sen.
Hold on. You can't just throw out a 25 ringgit 65 cent target when the stock is trading at 17 ringgit without some serious mathematical gymnastics.
I know, it sounds crazy.
Look at the standard valuation models cited in our sources, like the dividend discount model, the DDM.
Right, the DDM.
The DDM relies fundamentally on perpetual growth. It discounts future cash flows back to the present.
Correct.
HLI just admitted earnings are shrinking 16.5%. You cannot plug a negative growth number into a Gordon growth model and magically spit out a 25 ringgit target price. The math breaks.
That is a fantastic pushback, and you are right that a single-stage model would break under those parameters.
So how are they getting there?
The analysts are utilizing a multi-stage approach heavily reliant on what I call the dividend anchor.
The dividend anchor.
Yes, the short-term contraction heavily impacts the near-term cash flow phase of the model. But let's look at the single most crucial data point from the entire Q2 report.
Which is?
Despite the 39% plunge in net profit, Heineken Malaysia maintained their 40-cent interim dividend.
They held the line on the payout despite the profit squeeze.
They kept it identical to last year.
Wow.
That 40 cent represents a 78% payout ratio of their current depressed earnings.
Okay, that's huge.
And because HEIM operates with zero debt and their core brewing operations generate exceptional free cash flow even in a terrible macro quarter, that dividend baseline is incredibly well protected.
So they have the cash to keep paying it.
Exactly.
Okay.
The DDM values a company based on the present value of its future dividend payments.
Right.
So by holding that 40-cent dividend steady, HEIM provided a concrete, reliable floor for the expected near-term cash flows in the model, which stabilizes the overall intrinsic valuation.
Ah, I see. So even if the immediate growth variable is temporarily stalled by inflation and inventory adjustments, the sheer reliability of the cash being handed back to investors anchors the terminal value of the stock.
Precisely. And if we layer market psychology on top of that math, HLIB points out that the Malaysian brewery sector is currently trading at roughly 1.2 standard deviations below its 5-year historical average.
That's a deep discount.
It is. Institutional analysts believe the market is aggressively overpricing the short-term volume disruption.
They're panicking.
Yeah, and completely discounting the company's structural cash generation moat.
So if you believe the Middle East shipping disruptions and the local inventory corrections are temporary phenomena,
then buying at 17 ringgit means you are acquiring an exceptionally safe, high-yielding dividend stream at a steep historical discount.
you are essentially getting paid a premium yield to wait for the macroeconomic recovery.
Exactly. You get paid to wait.
Getting paid to wait is a solid defensive strategy.
It is.
But eventually, a defensive strategy isn't enough. You need actual top-line growth to drive capital appreciation.
You need to sell more beer.
Right. And if the domestic Malaysian market is so sluggish and consumers are persistently trading down, where does the future volume actually come from?
That's the million-dollar question.
Management can't just rely on relentless price hikes and internal cost-cutting forever.
Well, the answer to that is the most exciting catalyst hidden in this entire stack of reports.
Okay.
It completely shifts the narrative away from domestic sluggishness.
I read through the management commentary, but what is the specific catalyst?
It involves a major structural shift in Singapore.
Singapore.
Yeah. Asia-Pacific Breweries, Singapore, or APBS, is officially transitioning toward an import-based supply model.
Meaning they are winding down their physical brewing operations within Singapore.
Yes. The cost of manufacturing in Singapore land, scarcity, water costs, general overhead, is making large-scale brewing increasingly prohibitive.
That makes sense. Singapore is expensive.
So Heineken is gradually moving production out, and the facility stepping up to absorb that massive production load.
Heineken Malaysia.
Exactly. Managing Director Martien van Keulen confirmed in the reports that HEIM is investing heavily right now in a, quote, top-notch, modernized bottling line.
Specifically to support this cross-border transfer of production.
Precisely.
That completely changes the scale of the business.
It's massive.
Instead of fighting tooth and nail for incremental percentage points of market share in a mature, sluggish Malaysian economy, they are suddenly inheriting a massive, pre-existing chunk of the Singaporean market's volume.
The sheer volume projections from HLI on this transition are staggering.
Break down the math for us.
HLI estimates that if approximately 80% of Heineken Singapore's historical production volume is routed through the Malaysian facility by 2027.
80%.
Yeah, 80%. It would add roughly 240,000 hectoliters of additional annual volume to the local brewery.
Wow. Put 240,000 hectoliters into perspective for us. How big of a bump is that relative to their current output?
It is equivalent to a massive 20% increase over HEIM's current total domestic sales volume.
A 20% sudden expansion in volume.
Huge.
Just hand it to them through a corporate restructuring.
Yep.
Let's tie this back to our earlier discussion about operating leverage.
Oh, this is where it gets good.
We established that a drop in volume violently compresses their profit margins because those heavy fixed costs are spread over fewer bottles.
The exact inverse happens when you suddenly inject 20% more volume into an existing operational brewery.
Because the overhead is already paid for.
Exactly. The heavy fixed costs, the facilities, the equipment depreciation, the baseline energy are already fully covered by the domestic Malaysian sales.
Oh, that is brilliant.
So that massive influx of Singapore export volume will benefit from incredible economies of scale.
The margins are going to be crazy.
The profit margin on those exported hectoliters should be exceptionally high. That is highly favorable operating leverage.
So if we synthesize this entire narrative, the Q2 pain suddenly looks a lot more strategic.
Doesn't it?
Management is maintaining a zero-debt balance sheet, and they are willing to take a brutal, ugly, short-term hit to earnings to flesh out their local inventory channels right now.
Yes.
And they are doing this because they need a clean, highly efficient operational machine to handle this massive 20% influx of Singaporean production next year.
You cannot smoothly integrate a massive export operation if your domestic supply chains are clogged and your warehouses are stuffed with slow-moving inventory.
Right.
The financial pain they are absorbing in Q2 2026 is actively creating the operational bandwidth for the structural growth of 2027.
Let's bring all these threads together because it has been a complex journey today.
It has.
We started with a terrifying 10.5% drop in the stock price down to 17 ringgit. The Q2 numbers are undeniably ugly, with profits down 39%. And our moat scorecard took a legitimate hit, dropping to a 7.5 out of 10 to reflect the genuine vulnerability of their fixed cost structure during a volume shock.
The margin pressure is a real near-term headwind that cannot be ignored.
But when we stripped away the accounting noise, the plunging NTA wasn't value destruction. It was just the mechanical byproduct of rewarding shareholders with a massive 338 million ringgit dividend payout.
Cash in hand.
Exactly. The core cash generation remains so resilient that the dividend anchor is perfectly intact.
Which is key for the DDM valuation.
And sitting just over the horizon, mostly ignored by the current market panic, is this massive Singapore production shift, offering a 20% volume runway with highly favorable margins.
Which leaves us with a compelling question for anyone analyzing this stock.
What's that?
Is the market pricing Heineken Malaysia for what it is today, bogged down in the temporary gloom of inventory normalization and macro headwinds? Or are they failing to price in what the company will become when those highly profitable Singapore exports come online?
I want to push that thought even further as we wrap up.
Okay.
Because if Heineken globally is consolidating its Southeast Asian production into Malaysia to leverage these cost efficiencies in logistics, could Heineken eventually evolve beyond just supplying Singapore?
Oh, that's an interesting angle.
Could this modernized bottling line turn Malaysia into the primary export hub for other neighboring high-growth Asian markets where local brewing doesn't make economic sense?
It's certainly a possibility.
If they can execute the Singapore transition flawlessly, the long-term regional ceiling for this company might be much higher than anyone is currently projecting.
The foundation would definitely be there.
That is a thread well worth pulling on your own.
Absolutely.
Thank you so much for joining us on this deep dive. Navigating these corporate reports and market overreactions isn't easy, and we appreciate you trusting us to help unpack the mechanics behind the headlines.
It is a wild market out there.
It sure is. If this episode helped clarify the reality behind Heineken Malaysia's recent drop, please hit that like button.
We really appreciate it.
We also want to hear from you. Drop a comment below. Do you think 17 ringgit is an absolute steal given the Singapore catalyst? Or is the macroeconomic environment too risky to step in right now? Let us know your thesis.
We read all the comments.
And of course, subscribe to the channel so you are front and center for our next deep dive. Until next time, keep looking past the surface.